The Federal Reserve is purchasing $16 billion in Treasury bills this week. Two operations: $8 billion on March 3rd, $8 billion on March 5th. On the surface, this appears routine, a small liquidity adjustment within the Fed's post-quantitative tightening framework. But in a system carrying nearly $39 trillion in federal debt and navigating geopolitical volatility, even routine liquidity calibration carries weight. The critical question is not whether $16 billion is large. It is whether the Fed anticipates tighter funding conditions ahead, because liquidity stress rarely announces itself loudly. It begins quietly, in reserves, in repo markets, in short-term funding spreads, and in leveraged systems. Early calibration matters. Since December 2025, the Federal Reserve has been conducting reserve management purchases, or RMPs. These are not quantitative easing. They are not long-duration bond purchases. They are short-term Treasury bill operations designed to maintain an ample level of reserves in the banking system. After years of balance sheet contraction under quantitative tightening, reserve levels declined. The Fed's ample reserves framework requires sufficient liquidity to prevent short-term funding volatility. This week's $16 billion fits inside the broader monthly pace of approximately $40 billion. It is structured. It is pre-announced. It is mechanical. Reserves enter the system through the New York Fed's open market desk. This is not broad money expansion. It is plumbing maintenance. But plumbing in a leveraged financial system is not trivial. It is foundational. The timing is worth noting. Tax season approaches in April, historically, a period that drains reserves from the banking system. Short-term funding markets have shown occasional tightness since late 2025. Energy volatility adds uncertainty to inflation expectations. Treasury issuance remains elevated. Liquidity stress rarely begins with headlines. It begins with subtle friction. The Fed's ample reserves regime is designed to be proactive, not reactive. By purchasing short-term bills now, the desk smooths reserve levels before volatility compounds. This is calibration, not crisis response. But calibration suggests awareness, and awareness suggests anticipation. The United States currently carries approximately $38.75 trillion in federal debt. Net interest payments exceed $1 trillion annually. In a system operating at this scale, liquidity stability becomes strategically important. Stable reserves help anchor short-term rates. Anchored short-term rates support orderly Treasury market functioning. Orderly Treasury markets sustain rollover confidence, and rollover confidence sustains leverage. Higher yields, whether from inflation shocks or geopolitical risk premiums, would compound debt servicing pressure. Reserve management does not eliminate structural debt dynamics, but it reduces the probability of liquidity-driven instability. It buys time, and time is the most valuable asset in a leveraged system. Is this a signal of deeper concern? Not overtly. The Fed has been transparent. Reserve management purchases are distinct from quantitative easing. They do not target long-term yields. They do not expand the balance sheet beyond the planned envelope. They are technical. But in tense environments, rising debt burdens, energy volatility, fiscal strain, routine actions take on interpretive weight. Liquidity begets confidence. Confidence sustains demand for dollar assets. Demand for dollar assets anchors U.S. leverage. The edge lies in recognizing when routine operations become structurally essential. When small liquidity calibrations are not optional, but necessary. The United States does not maintain dominance because it carries less debt. It maintains dominance because its debt markets remain liquid and trusted. Liquidity is not glamorous, but it is strategic. If reserve levels tighten unexpectedly, funding markets can reprice rapidly. That repricing can transmit into yields. Yields transmit into fiscal flexibility. Fiscal flexibility influences geopolitical positioning. Small reserve calibrations preserve large structures, and in leveraged architectures, preservation matters. The Fed's $16 billion Treasury bill purchased this week is routine. But routine in a leveraged system is never neutral. It maintains the plumbing so the machine continues operating smoothly. In an era defined by elevated debt and shifting global confidence, even technical adjustments carry strategic implications. Understanding liquidity is understanding control. If you follow macro capital flows and structural shifts in global power, subscribe for deeper analysis. Because in leveraged systems, small adjustments preserve large structures. Routine today, structural tomorrow.